Hey, what's up, stock compounders? Brad here. So just this morning, I saw Chris Bloomstran of Semper Augustus had released his annual letter. Okay, the 2022 annual letter. Now this thing is a beast. Okay, if you go to my Twitter, you can find the link. It is 146 pages. Okay. Incredible. I mean, it's amazing how much time he must have spent putting this together. Just a fantastic resource for investors. So there's a few sections of the letter I kind of want to talk about today. The first one is this discussion of the Nifty 50 stocks of the late 60s, early 70s. There's a lot of talk about how, if you had bought the Nifty 50 and held on until today, even though you would have lost 90% of your money on paper, in the 1973-74 crash, you'd have beaten the market over 50 some years. So Chris really dives into that and calculates how you would have done investing in the Nifty 50 starting in 1972 and holding for 50 years versus the S&P. One thing I've been thinking about this a lot, owning great businesses, paying up for them, does that make sense if you can hold for a long enough time? And so this was a very interesting study to me. And Howard Marks talked about it recently. I think it was about a week ago. I put out a video on Howard Marks' talk at Chicago, University of Chicago, where he also talked about the Nifty 50. And I did a little digging myself, and I'll bring that into this conversation. So we're going to talk a little bit about the Nifty 50. And of course, Chris Bloomstran, for anyone who knows him, he's the guy every year who puts out, kind of an updated intrinsic valuation for Berkshire Hathaway. Really gets deep into the weeds. So we're going to look at that towards the end and see, where does he think Berkshire is trading these days as compared to what its intrinsic value is. I think you may be surprised. I was surprised at what he came up with for that. And then just a quick shout out for Ticker Terminal. You can see here the current holdings for Semper Augustus. Berkshire does make up about a third of the portfolio between the A and the B shares. So very concentrated in Berkshire Hathaway. All right, so what happened with the Nifty 50 if you had held for the last 50 years, starting in 1972? First of all, what are the Nifty 50? The Nifty 50 were a group of growing blue chips that traded for double the market multiple to earnings in 1972 and subsequently crashed far more than the market during the 73-74 bear market. Modern dogma suggests that the high multiples paid for the Nifty 50 stocks in 72 were warranted, and that as great businesses, the group ultimately outperformed the stock market, justifying the case for paying outrageous multiples in the most recent mania. Now, I didn't realize people were using this as a reason to just be paying up for companies like Tesla, Netflix, right? Apple, Amazon, Google. But I guess people made that connection. The group ultimately outperformed the market, justifying the case for paying outrageous multiples. Conventional wisdom is wrong. Okay, the Nifty 50 proved to be less than nifty, certainly for those paying 1972 multiples. So really, the lesson Chris is trying to hammer home here is that price matters, okay? You can't pile into a great business at any price and expect to do well, even over a very long period of time. So he really gets into the weeds on calculating how you would have done investing in the Nifty 50. And I'll just get to the punchline here. So for a full 50 years, the vaunted one decision stocks, the Nifty 50, produced a 10.1% annual return, trailing the S&P 500 by 0.25%. Okay, so the Nifty 50, if you had had the stomach to hold those from 72 basically until today, you wouldn't have done as well as owning the index, right? The S&P 500. So that would have been a pretty sad outcome for all of that turbulence you would have had to endure over those years. So close, but did not perform the S&P 500. And then it kind of breaks down how the winners did versus the losers. And there's a great table. This one's pretty good too. Towards the back in the appendix, there's a lot more detail on some of these companies. But you can see Philip Morris, okay, was far and away the outperformer of the Nifty 50 if you had held to today. The weight of that one company in your portfolio, right, 2% back in 1972 grew to about 23% of the portfolio. Even though it only did less than 3% better annually versus Pepsi, because it's over such a long period of time, that couple percentage points of annual outperformance adds up to a huge difference in weighting after 50 years. So you can see all of the Nifty 50 constituents and how they did over the last 50 years. And of course, these 7 didn't work out, right? You lost all your money on those. I want to actually jump to the end because I think it's fascinating. 142. So this is in the appendix. Return of $100 by original position with corporate action. So this must have been a ton of work that Chris Bloomstran did on this. So it shows the original investment and then, spin-offs, how that investment broke down over a holding period of 50 years. So you can see Merck came out of Hubeline. I'm probably saying that wrong. Pfizer out of American Home Products, and then further into Zoetis and Viatris. So it's just really interesting to see how over a period of 50 years, these investments kind of fractal off into these other companies. So you can really get a sense for how that unfolds over such a long period of time. Now, there was an exclusion here. Of course, remember, Bloomstran owns Berkshire as a third of the Semper Augustus portfolio. So he says, instead of hypothesizing that investors pay up for growth, how about an examination of one conspicuous missing element to the original Nifty 50? Had only the creators of the venerable list of one-decision stocks cast their gaze to flyover country. There was a place in Nebraska where a high rate of durable compounding was ongoing and on sale, right? The niftiest one. No Semper Augustus analysis of the Nifty 50 would be complete without introducing one glaring omission by creators of the Nifty 50 list and by investors building portfolios in 1972. That would be failure to include and invest in Berkshire Hathaway, the niftiest one. Had Berkshire been included in the list, its returns would have topped the list, compounding at 18.7% annually for those 50 years. Okay, 18.7%. I think that's versus 15 some odd percent for Philip Morris. Right, 15.6% for Philip Morris. So okay, he makes the case one could have identified Berkshire Hathaway as a great company in 1972, and clearly that would have paid off. But there's a glaring omission here, from my perspective, in Chris Bloomstran's annual letter. And that glaring omission is Walmart. Okay? Walmart was a public company in 1972. In fact, it was public in 1970. It was trading over the counter in 1970 and uplisted to the New York Stock Exchange in 1972. And the interesting thing to me is that Walmart did even better than Berkshire Hathaway over those 50 years. Walmart generated about a 22% annual rate of return over those 50 years, which is, as better as Berkshire Hathaway was versus Philip Morris. Walmart was that much better than Berkshire Hathaway. Obviously, we're comparing giants to giants here, but I just want to point out here that there's a glaring omission, okay? And perhaps we have some of the liking, loving tendency shining through here for Chris Bloomstran. Obviously, he's a fanboy of Warren Buffett and Charlie Munger and Berkshire Hathaway. But, to me, that's a pretty glaring omission as well. Now, I don't know if you go back to 1972, if it's obvious that Walmart should have been on the list. Maybe it would have been more obvious at that time that Berkshire would have been more compelling than Walmart. But with the benefit of hindsight, Walmart did perform better than Berkshire Hathaway. In fact, you'd have 3 times as much money today investing in Walmart versus investing in Berkshire Hathaway in 1972. So I just thought that was interesting. Also, as an aside, if Walmart was in the Nifty 50, right? Walmart was one of the Nifty 50 stocks, and you equal weighted, you only put 2% of your money in Walmart, and everything else went to zero. Okay, we saw that everything else didn't go to zero, but let's assume everything went to zero except Walmart. You still would have beaten the market. Okay, something like 13% annualized versus the market's 10.25%, which just shows you if you're able to get one great business in your portfolio that has a long runway, it can completely transform your net worth, your portfolio. It's the power law, right? If you have one incredible bet, this is kind of the venture capital model, all you need is one or a couple incredible bets, even if they're a very small percentage of the portfolio, to do incredibly well. So I just wanted to include that in this analysis of the Nifty 50. Now, let's get into what Christopher Bloomstran is best known for, valuing Berkshire Hathaway. So where are we at with price as compared to intrinsic value for Berkshire? So last year, same as this year, Chris Bloomstran aimed to calculate the intrinsic value of Berkshire using 4 different methods. Sum of the parts, GAAP adjusted financials, simple price to GAAP book value, or a 2-pronged approach. And then he just took the average, right, to kind of estimate what intrinsic value might be. And he talks about how these methods compare to each other. Some methods are more conservative at times and less so at others. The 2-pronged approach, used intermittently by Berkshire, makes no judgment about the degree to which the stock portfolio is under or overvalued. So I'll let you guys read through that if you want. This is the part I want to cover. Semper's methods of valuation are described briefly below. Past letters delve into more detail of each. In total, Berkshire trades at a considerable discount to intrinsic value. I wouldn't have necessarily guessed that. The A and B shares closed the year. A shares 468 some thousand. B shares $308.90 per share, using the average of methods at $631,421 per share. Berkshire's shares trade at 74% of fair value, giving us a 35% upside to fair value. That's pretty compelling. That's a significant discount. Excluding our price-to-book method for valuing Berkshire, an average of the remaining three methods suggests fair value. You can read the numbers, making the discount to intrinsic value 71.8%. The shares trade at year-end for 12.7 times earnings. Okay, current economic earnings. And Chris goes into a lot of detail about exactly how to calculate these different kinds of earnings. Of the four methods for valuing Berkshire, the sum of the parts basis and gap-adjusted financials approach should be more heavily emphasized in today's environment. Some assumptions and adjustments made top-down in the gap-adjusted method are likewise incorporated at the group level. When earnings are neither depressed nor above normal profitability, the two approaches should yield similar results. Any valuation figures are not meant to imply precision. So you guys can read through this, but the surprising thing to me is this 35% upside to Chris Bloomstran's approximation of fair value. Okay, that's significant. So the rule of thumb I've been using for Berkshire Hathaway is fair value is approximately 1.2 times book value. Okay. I believe if ticker would load here, thank you. Oh, it's kind of dipped a little bit recently. I thought we were around 1.5 times book. Obviously, this is an incredibly rough estimate of where fair value is. So right now we're at about 1.49 times book. And we can pull up what it's looked like over time. Price to book ratio. We can go back 10 years. Let's see what that's looked like. So, really took a dip when the pandemic started back in mid-March of 2020. Very rarely drops below 1.2 times book over the last 10 years. You can see it dipped just recently last summer, June of 2022, just below 1.2. I think part of the reason for that, when it starts to get close to 1.2, Berkshire tends to start buying back shares, which makes the price rise. But it's interesting being right now at 1.5, and Bloomstran still sees quite a bit of discount to intrinsic value. So I just thought that was pretty interesting. So this is well worth spending a few hours on. These 146 pages from Chris Bloomstran. And, I was just curious, right before I made this, I was curious how Semper Augustus's returns have compared to Berkshire Hathaway since the inception of the fund. I thought, well, that'd be kind of a bummer if, Berkshire outperformed Semper Augustus, right? I was kind of thinking that might be the case, but it wasn't the case. So Semper Augustus, gross of fees since March 1999, when it was when the inception happened, 9.7% per year. Okay, Berkshire is around 8.2% per year. So even after fees, Semper Augustus has outperformed Berkshire Hathaway over the last, 23 years or so. So that was encouraging to see. There is a little bit of outperformance there. Yeah, so a worthwhile letter to really digest here. I really appreciate how much time he spent putting this together and the detail, the level of detail he goes into here. I wish he would have included Walmart, or at least some explanation for why Walmart wasn't included in that calculation of Nifty 50 returns. I just saw today, I was reading through these Berkshire letters to shareholders for the last 50 years. Not 50 years anymore, but 1965 to 2014. And Charlie Munger pointed out Walmart was one of the biggest mistakes of omission for Berkshire Hathaway. They should have been able to see the value in Walmart fairly early on, and they just missed it. So it was good. I love when investors own up to their mistakes. Warren and Charlie are incredibly good at that, right? They're very honest, very forthcoming in where they could have done better. So I think that's it, guys. Hope you enjoyed that kind of quick highlights reel of the Semper Augustus annual letter. Again, if you want to read it, check it out. I've got a link on my Twitter feed. And that's all for today. I'll see you all in the next video. Take care.